Hello, welcome to you in finance class. I am Bhoj Raj Pangeni. In today's video, we are going to discuss about the numerical problem of short-term financing. Before going to the numerical, we have to see about the types of short-term financing. Have a look on this. The short-term financing has a two source, that is spontaneous source and non-spontaneous source, or source of short-term financing or types of short-term financing are same. Spontaneous means automatically created while doing the normal business, and non-spontaneous means negotiated, that is we have to negotiate. Okay, the spontaneous, under this spontaneous the accruals, trade credit are dealt, and under the non-spontaneous the short-term bank loan, line of credit and commercial paper are dealt. Okay, all the red color are important and other are no more important, so we have to discuss about the red color highlighted. Okay, the trade credit means suppliers. Okay, suppliers grants the credit for us, so this is the trade credit. And the short-term bank loan is the loan taken from the bank, and it has a two types, simple bank loan and discount bank loan. Simple bank loan means the payment made at the end of the payment of interest made at the end of each year, and the discount bank loan means the interest are paid at the beginning of year. So the discount means the beginning of year and the simple means the end of year. And the line of credit is similar to the bank overdraft, or it will be the known as the revolving credit, line of credit, revolving credit. Okay, the commercial paper is the short term financial instrument issued by the corporation for short term financing. Okay, and the add on interest loan is the installment loan. It's a types of short term bank loan. This is not more important. Okay, now we have to know about the trade credit. Trade credit means the total cost equal to the cost of financing into forgo discount rate. Okay, credit term, have a look on credit term. 210 net 40, what does it mean? 210 net 40, what does it mean? 210 net 40 means 2% discount allowed it if payments are made within 10 days. Okay, 2% discount are allowed it. If you pay within 10 days, you can get the 2% discount. Otherwise, you have to pay within 40 days. That is your credit period. Okay. Now, 2. The 2 is the discount rate in percent. That is called DR. Okay. Be aware of the notation DR. DR means the discount rate in percent. 2% is the discount rate, and the 10 is the discount period in days. Okay, we called it as a DP. DP means discount period, and the 40 is the credit period or payment period in days. Okay, whether we have to use the CP or you have to use the PP, payment period. Okay, this is the 210 net 40 whole is known as the credit term. Now, the annual percentage cost APC of foregoing the cash discount. Okay, if you don't have a money, you cannot take the discount of 2% because you don't have a money to pay within 10 days. So you have to forego the discount. You can't take the discount. So the annual percentage of cost of not taking discount or foregoing discount. Okay, that is equal to the DR. DR means discount rate. Have a look on the notation. DR upon 100 minus DR into days in a year divided by CP minus DP into 100%. Okay, this is the annual percentage cost, not a rupee cost. Okay, not a monetary value. It is the percentage value. And the effective annual rate Effective annual rate means 1 plus dr upon 100 minus dr to the power days in a year divided by Cp minus dp, the whole minus 1. Okay, this is the effective annual rate, the formula of effective annual rate. Okay, now the point 2, short term bank loan. In short term bank loan, the term compensating balance, you have to know about the term compensating balance. Compensating balance means the minimum cash balance should be maintained in the bank or retained by the bank. If it is given in the question, please deduct it. Don't forget to deduct the compensating balance. Okay, always you have to deduct the compensating balance in every question. In every question, if there is the compensating balance, you have to deduct. Okay, it is given in the red line because it is very important, and most of the students forget about this compensating balance and they cannot deduct it. Now, number A, simple interest loan. For this simple interest loan means the payment, interest of payment or interest are paid at the end of each year. Interest is paid at the end of each year is called simple interest loan. Okay, now also known as the collect basis loan. Okay, one, if compensating balance is not given, if compensating balance is not given, then APC or EAR equal to the interest rate divided by 100 into 100%. And or you can use the another formula, interest amount. The first one is the interest rate formula, this is the rate formula, and this is the amount formula. This is the amount formula, interest amount divided by principal into 100%. Okay, interest amount divided by principal into 100%. This is the amount formula. You can write only one, you don't have to write both formula. Whether you have to know the first formula and you have to know about the second formula, but first formula is always easier. You can directly put the interest rate. And number point 2, if compensating balance is given, look at rate, compensating balance is given, deduct it. Okay, deduct from where? APC or EAR, both APC or EAR. Interest rate divided by 100 minus CB rate. Have a look, CB rate is deducted from 100. Okay, CB rate, if compensating balance rate is given, then you can deduct from 100. Or you can use the formula method number 2, that is from amount. Interest amount divided by principal minus CB amount. Always use the amount. This one is the rate. Okay, interest rate, CB rate. Okay, and this is the amount, interest amount, principal amount, and CB amount. This all about the simple interest loan under the short term bank loan. And B1 is the discount interest loan, discount, green color. Okay, discount means interest is paid at the beginning of year. Okay, also known as the advance interest loan. One, if compensating balance is not given, then APC or EAR equal to the interest rate divided by 100 minus interest rate. Okay, IR divided by 100 minus IR into 100%. Okay, interest amount divided by principal minus interest amount. This one is the amount formula. And number point 2, if compensating balance is given, then you have to deduct it. Interest rate divided by 100 minus interest rate minus CB rate. Okay, there is a less. Okay, discount interest loan, in this loan the interest is deducted and the compensating balance is given in the question, then the CB rate also deducted. If not given the CB rate, then you don't have to deduct it. This formula is the amount formula, interest amount divided by principal minus interest amount minus CB amount. You can use any one of them. Okay, you don't have to use both formula. Okay, first one is easier and second one is a little bit lengthy. Third is the line of credit. Line of credit is an arrangement in which the bank agrees to provide the money to the specified maximum amount of fund during the given period. That is short term period. Okay, they are similar to revolving credit and bank overdraft. Total cost in amount, interest plus commitment fee are the total cost. So interest is paid for used amount of fund. Please be aware of that. Please give the attention. Interest is paid for used amount of fund, whereas commitment fee is paid for unused portion of fund. Don't forget this line. Interest is paid for used amount and commitment fee is paid for unused portion of fund. Okay, then APC or EAR equal to the interest plus commitment fee divided by net used amount. Interest plus commitment fee divided by net used amount into 100%, and net amount used or net used amount equal to the total fund into days or month of fund used divided by days or month in a year. And the used amount is the total fund minus net used fund. Interest equal to the net amount used into interest rate. Commitment fee equal to the unused amount into commitment fee rate. Now, number 4, commercial paper. A short-term promissory note. A short-term promissory note issued by high credit rating corporation is called the commercial paper. It has a two cost, interest cost and placement cost. Placement cost means flotation cost. Okay, the total cost in amount means the interest cost plus placement cost. APC means annual interest plus annual placement cost divided by CP amount or usable fund. And the APC another formula is the interest plus placement cost divided by CP amount or usual fund into days or month in a year divided by maturity, days or month. If the days in a year is given or maturity is given in the days, so the days in a year you have to write. If the maturity is given in month, then month in a year you have to write. Okay, then EAR equal to the 1 plus APC divided by m to the power m minus 1, where m equal to the number of compounding in a year. Number of compounding in a year for semi-annually is 2, m equal to 2 for semi-annually, quarterly m equal to 4, monthly m equal to 12. Okay. Now, if any ideal fund of CP has been used for investment, then the return is deducted while calculating total cost of CPs. Okay. Now, have a look on the question. BR Corporation wishes to borrow rupees 500,000 for 1 year. It has a following available alternative. Okay. A, of 15% loan on collect basis with no compensating balance requirement, and B, a 12% simple interest loan with 10% compensating balance requirement, a 12% simple interest loan with 10% compensating balance requirement. Okay, and C, a 12% loan on a discount basis with no compensating balance. 12% loan on discount basis, no compensating balance. And the D one is a 8% advance interest loan with 20% compensating balance. Have a look on A, B, C, D. In A, 15% loan, that is interest rate on collect basis, that is simple interest with no CB. Okay, simple interest with no CB, simple bank loan with no CB. 12% simple interest loan with 10% CB, that is the simple interest. Both A and B are the simple interest. One is the no CB and another is has a CB. And C and D are the discount basis loan, advance loan. One is compensating balance and another has don't have compensating balance. So which alternative would BR corporation choose? Okay, if it concerned with effective interest rate, you have to calculate the effective interest rate. Now given loan amount or principal amount is 5 lakh or 500,000 and the effective annual rate EAR equal to what? For A, interest rate IR equal to 15%, that is simple interest rate, and the compensating balance is not given, so CB equal to 0. Now EAR equal to interest rate divided by 100 into 100%. Okay, interest rate means 15% divided by 100 into 100%. 15% is our simple interest loan. Effective rate also 15%. And next one is our formula, that is the interest amount divided by principal. Interest amount means 15% of 5 lakh. Okay, 15% of 500,000 divided by principal means 500,000 into 100%. The answer is same. For B, interest rate IR equal to 12%, simple. Okay, then the interest amount equal to the 12% of 5 lakh, that is 60,000, and the compensating balance is given in this B portion. So the CB equal to 10%, that is CB amount equal to the 10% of 5 lakh, that is 50,000. Now EAR equal to the interest rate divided by 100 minus CB. If the CB is given in the question, then always deduct the CB. Always deduct CB. Always minus the CB. Interest rate, that is 12%, divided by 100 minus CB, 10%. Okay, 12 divided by 100 minus 10 into 100%. We can get 33.33%. Or you can use the amount formula, interest amount and principal and CB amount. You can put the formula and you can get the same answer as calculated above. You can use any one of them. Don't use both formula in the examination because you don't have time. Okay, only easier method you can use. Which one is easier you feel, you can use. Now it's time for C, interest rate IR equal to 12% discount interest, because this is the discount. Interest rate is paid at the beginning, so interest rate is 12%, that is discount rate, and the interest amount is 12% of 5 lakh, that is 60,000, and the compensating balance is not given in C. Okay, compensating balance is not given in C, so EAR equal to interest rate divided by 100 minus interest rate, because the interest is less because it is the discount interest. Okay, in the discount loan, you have to deduct the interest. Okay, in the discount you have to deduct the interest. 12% divided by 100 minus 12 into 100, that is 13.64% is our EAR. Or you can use by the amount formula, you get the same answer, there is no any difference. Okay, then part D, interest rate IR equal to 8%, that is discount interest rate, and interest amount is 8% of 5 lakh, that is 40,000, and the compensating balance is given in the question, that is 20%. The CB amount is 20% of 500,000, that is rupees 100,000, 1 lakh. Okay, then the EAR equal to the interest rate divided by 100 minus interest rate minus CB rate. Okay, CB rate, 8 divided by 100 minus 8 minus 20 into 100%. 8 divided by 100 minus 8 minus 20 into 100%. That is 11.1111% is our EAR. Use another formula, that is amount formula. EAR equal to the interest amount divided by principal minus interest amount minus CB amount into 100%. Put the value of each variables factors. 40,000 divided by 5 lakh minus 40,000 minus 1 lakh into 100%. The answer is same, 11.11%. This is the decision. Since the EAR of alternative D, okay, EAR alternative D, alternative A, B, C, D, 4, there are 4 EAR. Among them, the EAR of alternative D is lower than other. The alternative D should be selected because here all these are the cost, okay, cost of fund. So lower the cost is better for corporation, so lower value should be selected. Since the EAR effective annual rate of alternative D is lower than other, alternative D should be selected. This is our decision. Now another question, have a look on another question. BR company required fund of rupees 3 lakh or 300,000. The company has a following alternative: A, forgo the trade discount on term 210 net 70. The term is 210 net 70. B, issue 60 days commercial paper or 2-month commercial paper at 9% interest. The placement cost would be 5,000 per issue. And C, establish 1-year line of credit of 300,000 from a commercial bank. The fund has been utilized only 70% of commitment fund at the rate of 15% per annum. The bank charged 2% commitment fee on unused fund. Okay, the assume 360 days in a year. Now required, which alternative should BR company choose if concerned with annual percentage cost? Which alternative should BR company choose if it is concerned with effective annual rate? We have to calculate both annual percentage cost APC and effective interest rate EAR. We have to calculate both and you have to take the decision for A, B, C. A has a 210 net 70. B has a 60 days commercial paper, 9% interest, 5,000 issue cost or placement cost. C, established 1-year line of credit, that is 3 lakh of line of credit, 70% are used and 2% commitment fee, 15% interest rate. Assume 360 days in a year, don't write 365. Now for trade credit A alternative, the term is 210 net 70. The term is 210 net 70. That means the discount rate is 2% and 10 is our discount period and 70 is our credit period. Okay, DR, CP and DP, all three information are given. Days in a year, 360 days. Don't write the 365 days because in the question the days in year is given, so write the 360 days. And the APC, annual percentage cost, APC equal to what? Effective annual rate, EAR equal to what? APC equal to DR upon 100 minus DR into days in a year divided by CP minus DP into 100%. Put the value of DR, days in a year, CP and DP from the given information. 2 divided by 100 minus 2 into 360 divided by 70 minus 10 into 100%. Now you can get 12.24% as the APC of trade credit. Okay. Now it's time for calculating the effective annual rate EAR. AR, the formula of AR equal to 1 plus DR upon 100 minus DR to the power days in a year upon CP minus TP minus 1. Put the value of DR, days in year, CP and DP. Now calculate. You can get the APC and EAR. Don't forget, the EAR is always higher than APC. If EAR is lesser than APC, your answer might be wrong. Your calculation might be wrong. Please be aware of that. Okay. And next one is the commercial paper. In the commercial paper amount is 3 lakh, that is 300,000, and the interest rate is 9% of 3 lakh. 9% of 3 lakh is 27,000. This is the annual interest rate, 27,000. Okay, interest amount is 27,000, that is annual interest rate, into 60 divided by 360, because the commercial paper is the 60 days commercial paper. Okay, 60 days commercial paper. So 60 days commercial paper, if company issue the 60 days commercial paper, the company should pay the 60 days interest, not to the whole year interest. So 27,000 is the 1 year's interest, annual interest. Convert it into the 2 month interest, that is 60 divided by 360, rupees 4,500 or 4,500 is our interest amount. And the placement cost PC equal to 5,000 per issue, and the maturity is 60 days, and the number of compounding in a year M equal to 6, because the 6 days means the 2 month, and number of compounding in a year M equal to 6, because every 2 month there is the compounding, then in a year there is 6 times of compounding. So APC equal to interest plus placement cost divided by CP amount into days in a year divided by maturity into 100%. Put the value of interest plus placement cost. Interest is 4,500 and placement cost is 5,000, divided by CP amount is 3 lakh, into days in a year is 360, divided by maturity is 60 into 100%. The APC is 19%. And the EAR, for EAR use this formula, 1 plus APC upon M to the power M minus 1. Put the value of APC and M and you can get the EAR. While putting the value of APC, don't forget to divide it, that is 19% divide equal to the 19% divided by 100, that is 0.19. okay, don't forget to write 0.19. don't write directly 19%, please don't write 19% directly. Okay, now the EAR is 20.57%. the EAR is 20.57%. Now it's time to calculate about the line of credit. The line of credit, the commitment fund, that is loan amount, commitment fund, bank have committed to provide the fund, that is 3 lakh, and fund used, that is 70% of commitment, is rupees 210,000. okay, and the unused fund is 30%, that is 19,000, 90,000, so 19 not 90,000. okay, 30% of 3 lakh, 3 3 is 9, 90,000, and the interest rate is provided on the fund used, so 15% of, please don't write the interest rate 15% of 3 lakh. okay, don't write the interest is the 15% of 3 lakhs. It is the 15% of 2,10,000, that is 210,000. 15% of 210,000, that is rupees 31,500 is our interest, and the commitment fee is the 2% of 90,000. don't write the 2% of 3 lakhs. okay, the commitment fund is provided on unused fund, so 2% of unused fund is 90,000. so this two information these two information is very crucial to calculate, and most of student fail to calculate. Okay, interest is provided on used fund. So fund used is 21,000, so interest is calculated in 21,000, sorry, 2,10,000. So interest is calculated on 15% of 2,10,000, and the commitment fee is used fund has been calculated by unused funds. So 2% of unused fund is 90,000, so calculate 1,800, 1,800 is our commitment fee. So APC or EAR equal to interest plus commitment fee divided by net used fund into 100%. Put the value, interest equal to the 31,500 plus commitment fee equal to the 1,800 divided by 10,000 into 100%, that is 15.86% is our APC or EAR both. Okay, now it's time for summary. For APC, trade credit has a 12.24%, commercial paper has 19%, and C, line of credit has 15.86% for APC only. For EAR, trade credit has 12.89%, B, commercial paper has 20.57%, and C, line of credit has 15.86%. Now all these are the cost, so the lowest cost is the best. Now take the decision. Since the APC or an EAR of alternative A, that is trade credit, okay, have a look on the APC of trade credit is lower than others, because the trade credit APC is 12.24% and commercial paper 19% and line of credit 15.86%. the lower is the trade credit. And for EAR, have a look on the EAR. Trade credit has the EAR of 12.89%, commercial paper 20.57%, and line of credit 15.86%. Now the trade credit has a lower EAR. So since the APC or EAR of alternative A trade credit is lower than other, trade credit alternative should be selected. Lower value should be selected because it's all about the cost, and the low cost is our motto. Low cost is our, if company use the lower cost, then company can get the more profit. Okay, so the lower cost is better to select. If you have any doubt relating to this lecture video, please comment it. You can comment, and don't forget to share and subscribe this channel for upcoming video. Thank you.